Welcome to the Deep Dive. Today we're tackling something so woven into the fabric of our economy. We often just take it for granted. Interest.
Right.
It's the cost of borrowing, the reward for saving. It sort of feels like it's just part of how things work.
Right.
But is it really that simple? Is it like a natural occurrence or something we've built and can, tinker with?
That's really the core question we're digging into today, and our guide is Edward Chancellor's, monumental work, The Price of Time.
Ah, yes. Great book.
It really is. And think of this as more than just a historical overview. It's about uncovering the surprising and sometimes, frankly, unsettling ways interest rates have shaped our world right up to today.
Okay.
Our aim really is to understand those impacts, especially the unexpected twists and turns we've seen recently.
Absolutely. So let's go way back. I mean, really way back. What can the earliest chapters of history tell us about how interest was understood and used?
Well, the origins are surprisingly deep. You go back to ancient Babylonia, thousands of years ago, and lending and borrowing were already pretty sophisticated.
Really?
Yeah, debts weren't just personal, they could actually be transferred, even inherited.
Mm.
And loan terms varied, depending on the need, short term maybe for harvests, longer term, even things called call loans payable on demand.
Wow.
What's really fascinating is that merchants even used what were essentially promissory notes to settle their own accounts. It shows a level of financial interconnectedness you might not expect quite so early on.
Okay, so even then, debt had this life beyond just the initial borrower. That's interesting. And what about interest itself? How did those early societies view the whole concept of charging for the use of money?
Well, the Sumerians had this particularly evocative term for compound interest, mash, which literally means the multiplication of livestock.
Ah, livestock.
Yeah, it paints a really vivid picture, doesn't it? How debt can grow and, replicate itself. Centuries later, Richard Price famously used the example of a single penny invested at the time of Christ.
Oh, I think I've heard this one.
Right. To illustrate this power of compounding, by the 18th century, that penny, even at a pretty modest interest rate, would have grown to an amount, far exceeding the entire mass of the earth in gold.
Incredible.
That image of debt just growing geometrically, it stuck with people throughout history. Thinkers like Marx and Proudhon cited it as this fundamental force in economic life.
Wow, that penny example really, really brings home the long-term power of compounding.
Yeah.
So even in these ancient times, were there any attempts to, influence or control interest rates? It sounds like something rulers would definitely have an opinion on.
You're absolutely right, there were. Even way back then, we see instances of rulers intervening in ways that affected interest rates.
Like what?
Well, after Alexander the Great's conquests and the subsequent spread of all that Persian gold and silver, historical accounts suggest that prices rose and, interestingly, interest rates actually declined.
Cool.
Similarly, you look at Roman emperors like Augustus and Tiberius. They took actions with direct monetary consequences. When Augustus brought the treasures of Egypt back to Rome, that influx of wealth is said to have lowered interest rates.
Right. More money supply.
Exactly. And conversely, when Tiberius got worried about hoarding, which led to a banking crisis, he famously lent out imperial funds interest-free to stabilize things.
Huh. Like an early QE or something?
It's a very early form of what we might, recognize today as a kind of quantitative easing. So the idea that authorities can step in to influence the cost of money, it has a really long history.
That's a fascinating parallel to modern central banking, isn't it?
Yeah.
Moving forward a bit, the whole idea of interest became this major point of philosophical and moral debate. It wasn't just like a practical thing anymore.
Absolutely. I mean, thinkers across different schools of thought held very, very strong views. You take the anarchist Proudhon, for instance. He saw interest as fundamentally unfair usury and plunder. That's how he put it.
Strong words.
Very. He believed it was an unearned reward for just possessing capital, a primary driver of inequality and poverty. His declaration, I call interest theft. I mean, that really encapsulates his radical opposition.
That's a pretty extreme position. So what was the opposing view? Who argued in favor of charging interest?
Well, a powerful voice against Proudhon's ideas was Frederick Bastiat. He argued that, look, if lending wasn't compensated with interest, there'd be zero incentive to lend at all.
Makes sense.
Abolishing interest, he believed, would essentially mean abolishing capital itself, which would lead to the disappearance of savings and ultimately harm the very people Proudhon wanted to help the poor, who wouldn't be able to get credit at any price.
Right, the unintended consequences.
Exactly. Bastiat stressed the importance of looking beyond the immediate effects. He distinguished between what he called the bad economist, who only sees the short term, and the good economist, who considers the long-term, wider consequences. Henry Hazlitt later expanded on this, emphasizing the unseen consequences of economic action.
Okay.
So Bastiat's core argument was basically that interest is a necessary incentive for a functioning economy.
So Bastiat is saying you need that reward to encourage lending, investment, and that looking at the bigger picture, abolishing interest would actually be harmful. What about the moral and religious arguments against interest? They were pretty influential for a long time, too.
Oh, definitely. The medieval theological perspective, particularly from figures like Thomas of Cobham, added this really profound moral dimension.
How so?
Cobham viewed usury not just as greed, but as a theft of time.
Theft of time.
Yeah. His reasoning was that time belongs to God, right? So therefore, no individual has the right to profit by selling someone else's time through interest. It really highlights how deeply moral and ethical considerations were tangled up with economic practices back then.
It wasn't just about money.
Not at all. It touched on fundamental beliefs about time and ownership.
It's really striking how this concept of time keeps cropping up with interest. It wasn't just about the money itself, but also opportunity cost, the passage of time. How did this understanding evolve beyond these sort of moral arguments?
Well, by the 16th century, you see a really insightful definition from Thomas Wilson. He called usury the price of time.
The price of time.
Chancellor points out this might actually be the most accurate, most enduring definition of interest we have. And over time, a distinction gradually emerged between interest and usury.
Oh, okay.
Queen Elizabeth I's law in 1571, for example, while it legalized lending at a capped rate 10%, it still differentiated between true interest, seen as fair, and usury, which implied, unfair or exploitative dealing.
Yeah.
That distinction, even though the specific rates have changed dramatically, it still sort of informs our understanding today.
So interest became more accepted, maybe, as a legitimate economic activity, but with this underlying sense that it needed to be fair, avoid exploitation. What about the economic theories trying to explain why interest exists? What are the fundamental economic reasons?
Yeah, so thinkers like Eugen von Böhm-Bawerk introduced this concept of time preference.
Time preference.
The idea that, generally speaking, people value having goods and satisfactions now more than having the same things in the future.
Okay, that makes intuitive sense.
And Irving Fisher famously described interest as human impatience crystallized into a market rate.
Huh. I like that. Human impatience crystallized.
Exactly. He saw it as the market's way of dealing with this fundamental issue of valuing things across different points in time. So this perspective suggests that a positive interest rate isn't just some arbitrary invention, it's more a reflection of our inherent human tendency to prefer the present.
Meaning we need some kind of compensation interest to delay gratification and lend out our resources.
Precisely. And this also hints at why negative interest rates can feel so counterintuitive. It kind of goes against this basic human preference.
Yeah, definitely feels weird. Okay, most of us would rather have something sooner rather than later, so there needs to be an incentive to wait. Now, let's jump ahead a bit to the 17th century. We start to see specific economic arguments being made in favor of low interest rates. What was driving that?
Well, a really prominent advocate for lower interest rates back then was Josiah Child. His main argument was basically that reducing the cost of borrowing would stimulate trade, boost the overall wealth of the nation, and even discourage what he saw as unproductive stuff, like idleness and excessive consumption. He was pretty optimistic, even suggesting the nation's capital could double in just 2 decades if rates were lowered.
Wow, ambitious.
Yeah, I mean, his views might have been partly influenced by his own interests as a businessman, sure, but they definitely ignited a big debate about what the optimal level of interest rates should be.
And naturally, not everyone agreed with Child, I assume.
Yeah.
What were the counter-arguments? Why did some people think low rates might actually be a bad idea?
Oh, yeah. Several pamphleteers jumped in to challenge Child. They drew an analogy between interest on capital and rent on land, suggesting both were sort of natural forms of income.
Okay.
They argued that higher interest rates actually played a useful role, directing money towards the most experienced, most capable traders, ensuring it wasn't wasted on less productive ventures.
Right, sort of allocating capital efficiently.
Exactly. And they also raised the concern that artificially lowering rates could backfire by encouraging people to just hoard their money, taking it out of circulation instead of investing it.
Ah, the hoarding problem.
Yeah. So deadly north, actually, in a way that sort of foreshadows later Keynesian ideas, even suggested that high rates could actually draw hoarded money back into trade, while very low rates might keep it locked away.
Interesting.
And John Locke also weighed in, arguing that the main beneficiaries of lower rates wouldn't necessarily be borrowers or trade in general, but probably the bankers themselves.
So even way back in the 17th century, you had this fundamental tension, wanting to stimulate the economy with lower borrowing costs versus worrying about unintended consequences like hoarding or just benefiting a select few.
Yeah.
This brings us nicely to the concept of the natural rate of interest. What exactly is meant by that term?
So the idea of a natural rate basically arose from understanding that interest wasn't just determined by monetary policy or how much money was floating around.
Right.
It was also deeply connected to the underlying real factors in the economy, things like productivity, the demand for investment. Hugo Grotius, for instance, while acknowledging historical prohibitions, argued interest wasn't inherently against natural law. By the 17th century, most English economic thinkers accepted interest as a natural part of economic life. The main debate really shifted to what the appropriate level should be.
So the natural rate is?
The natural rate was conceived as the interest rate that would balance the supply and demand for loanable funds, reflecting the economy's fundamental productivity and savings habits.
Okay, so it's the rate that's sort of in equilibrium with the real economy, not artificially pushed around.
Yeah.
What happens when the actual market rate starts to drift away significantly from this theoretical natural rate? What are the potential consequences?
Yeah, that's a crucial question. Henry Thornton, a very insightful banker in the early 19th century, really grappled with this.
What did he find?
He observed that when the market rate of interest, especially because of an expansion of paper credit at artificially low rates, meaning rates below this natural rate, when it diverges significantly, it can sow the seeds of financial instability. It can fuel unsustainable economic booms.
Robbles.
Exactly. He specifically saw the low rates of his time, partly due to usury laws that stopped the Bank of England from raising rates enough as encouraging excessive borrowing and speculative activity. And his warnings seemed pretty prescient given the financial crisis of 1810. So the key insight there is that a mismatch between the market rate and the natural rate can create these dangerous imbalances in the economy.
This idea of low interest rates acting as fuel for speculation, it just seems to be this recurring theme throughout financial history, doesn't it? Walter Bagehot, the famous 19th century financial journalist, he certainly had strong opinions on this link.
Oh, absolutely. By the 19th century, Bagehot had that famous quip that John Bull can stand many things, but he can't stand 2%.
Right, 2%.
He keenly recognized that periods of unusually low interest rates often coincided with these speculative manias popping up.
And he's the guy with the rule about central banks lending freely in a crisis.
Yes, exactly. He's maybe best remembered for that crucial rule. Central banks should lend freely during financial panics to stop contagion. But, and this is key, he also emphasized that this lending should be against good collateral and at penal, meaning high interest rates.
Which is a condition modern central banks haven't always strictly followed, maybe.
That's a fair point. Bagehot really understood the delicate balance between providing liquidity in a crisis and avoiding, the moral hazard of encouraging excessive risk-taking in normal times through persistently low rates.
That's such a critical distinction. Lend freely, yes, but responsibly and at a cost. We see a really dramatic historical example of low rates and rampant speculation with John Law's Mississippi bubble in France, early 18th century. Can you walk us through how low rates played into that extraordinary episode?
Oh, John Law. He was a fascinating, very controversial figure. He believed a nation's wealth wasn't just about its gold and silver reserves. So he established a royal bank that issued paper money, and this bank got closely intertwined with the Mississippi Company, which had a monopoly on trade with France's huge territories in North America.
Right, Louisiana and all that.
Exactly. Initially, the company's share prices just soared, fueled by super optimistic projections and really aggressive promotion. The French government's debt was even converted into company shares.
Wow.
And Law's Royal Bank provided loans to eager speculators at this remarkably low interest rate, just 2%, using those very Mississippi shares as collateral.
Oh.
Yeah. So in essence, bank money and Mississippi stock became almost interchangeable. And to further prop up the share price, the Mississippi Company even did massive share buyback programs financed with zero interest loans from Law's bank.
Zero interest. Good grief.
Law himself explicitly justified the sky-high share price by pointing to the low interest rates, arguing a low discount rate justified higher asset valuations. This ready availability of cheap credit just fueled an exponential rise in share prices. It was a textbook speculative bubble.
And as we all know, what goes up that fast? Well, it inevitably comes crashing down. The Mississippi bubble bursts spectacularly, right? Widespread financial ruin across France.
Absolutely. It's just a stark historical lesson in the dangers of artificially low interest rates inflating asset prices to completely unsustainable levels.
And interestingly, the South Sea bubble in Britain happened around the same time, didn't it? Suggesting maybe a broader European thing going on, perhaps linked to low rates everywhere.
That's a good point. It does seem like a wider phenomenon. And these weren't isolated incidents either. The banking crisis in Britain in 1825, that also had connections to the prevailing low interest rates.
How so?
Well, that crisis was triggered by the failure of a prominent bank, Pole, Thornton and Company. Contemporary accounts directly linked their downfall to the partners being too eager to find profitable places for their capital during a period of low rates.
So they took on more risk.
Exactly. It led them to invest in riskier, longer-term, and ultimately illiquid securities in South America. The political economist Robert Torrens explicitly connected the crisis to prior overspeculation, which he, in turn, blamed on the low prevailing rates of profit and interest in more normal investments.
Okay.
So again, it illustrates the point. When safe returns are suppressed by low rates, capital tends to chase higher, often riskier returns, potentially leading to financial instability.
So the pattern just continues. Low rates incentivize this search for yield, pushing investors, institutions towards increasingly risky assets. Now let's move into an era where central banks started to wield more direct influence, the gold standard. How did the sort of discipline of the gold standard constrain their ability to actively manipulate interest rates?
Right. The gold standard essentially pegged a nation's currency to a fixed weight of gold. This imposed really significant constraints on central banks' ability to conduct active monetary policy, including setting interest rates.
How did that work mechanically?
Interest rates were largely governed by international gold flows. If a country's rates were too low compared to others, gold would tend to flow out of the country.
Okay.
That would lead to a contraction in the money supply and automatically push interest rates higher. Conversely, higher rates would attract gold inflows, easing monetary conditions. It was this sort of automatic adjustment mechanism.
So less discretionary power for the central bank.
Considerably less, yeah. They couldn't just set rates based purely on domestic economic needs.
But even within that rigid framework of the gold standard, interest rates became a hugely politicized issue, didn't they? Especially in Britain's difficult attempt to return to it after World War I.
Precisely. Britain's decision to return to the gold standard at the pre-war parity, strongly pushed by Montague Norman, the powerful governor of the Bank of England, led to a period of really high interest rates, significant unemployment, and deflation. Even the Chancellor of the Exchequer at the time, Austen Chamberlain, opposed further monetary tightening because he saw the severe economic and social consequences. Norman himself later famously admitted he couldn't raise rates without provoking a riot.
Wow.
It just highlights how politically sensitive it had become. The widespread social unrest culminated in the general strike of 1926, and John Maynard Keynes became a particularly vocal critic of the gold standard and the policy of high rates, arguing they were deeply damaging to employment and recovery.
Right.
This period really underscores how interest rate policy, even under a seemingly automatic system like the gold standard, is never just a technical matter. It always has significant social and political dimensions.
So even with the gold standard's constraints, that inherent tension between economic necessity and political pressure around interest rates was very clear. Then we move into the Roaring '20s in the U.S., strong economic growth, but relatively low inflation. How did the newly established Federal Reserve navigate setting interest rates during this apparently prosperous time?
Well, the fact that inflation stayed relatively low through the 1920s gave the Fed considerable freedom to keep monetary policy relatively easy despite that robust economic growth.
Okay.
However, if you look back through the lens of Nutwick-Sell's concept of the natural rate of interest, which in theory should roughly align with the economy's underlying growth rate.
Right, we talked about that.
The Fed's discount rate, which averaged less than half of the nearly 8% annual growth rate back then, looks, in retrospect, to have been quite dough.
Why wasn't inflation higher then?
Well, the rapid productivity gains from new technologies like electrification helped keep inflationary pressures down. But that might have masked some of the stimulative effects of those low rates on asset prices and speculation.
Ah, So the surface looked calm on inflation, but maybe underlying imbalances were building because the policy rate was disconnected from the real growth rate.
That's a plausible interpretation, yes.
And this period of relatively easy money certainly fueled a significant speculative boom, especially in the stock market. Gains were increasingly driven by capital appreciation, not just wages and traditional business income. There's that famous anecdote about a coup de whiskey sours meeting among central bankers. What was the significance of that meeting regarding the Fed's easy money policy?
Ah, yes, the coup de whiskey sours. That refers to this fascinating, maybe pivotal, informal meeting in July 1927 where key central bankers got together.
Who was there?
Benjamin Strong from the New York Fed, Montague Norman from the Bank of England, they strongly advocated continuing cheap money policies. However, the representatives from the German Reichsbank and the French Banque de France vehemently opposed it.
Really? What did they say?
Hjalmar Schacht, head of the Reichsbank, reportedly stated quite firmly something like, "Don't give me a low rate, give me a true rate, and then I shall know how to keep my house in order."
Wow. Direct.
Yeah. But despite these strong dissenting voices, Strong went ahead with an interest rate cut in August 1927.
And the consequences?
Well, several unintended ones. It reversed capital flows. The slightly higher U.S. rates attracted funds from Europe, putting more pressure on their already fragile economies. It really highlights a crucial point. Monetary policy decisions in one major country can have significant, sometimes destabilizing effects globally.
Which ultimately leads us towards the catastrophe of the Great Depression. Irving Fisher's well-known debt deflation theory really underscores how falling prices can dramatically increase the real burden of debt. How did the low-rate environment of the 20s factor into that devastating deflationary spiral?
Fisher argued that as deflation takes hold, the real value of existing debt just skyrockets because borrowers have to repay loans with money that's now worth more in terms of what it can buy.
Right.
This increasing real debt burden forces borrowers to cut back spending, which contracts the money supply further, pushes prices down even more sharply. It creates this vicious cycle.
A really nasty feedback loop.
Exactly. And while low nominal interest rates might seem like a fix, in deflation, even seemingly low nominal rates can translate into very high real interest rates, the nominal rate minus the negative inflation rate. That just squeezes indebted individuals and businesses even more.
And this wasn't a new idea, hating unexpected deflation.
No, not at all. Jean-Baptiste Sauzet, way back in the early 19th century, argued unexpected deflation should basically be unlawful because it effectively changes the terms of contracts after the fact, forcing debtors to repay more in real terms than they borrowed.
But, as we know, there were sharply differing views on how to address the Depression. Friedrich Hayek, for example, was a strong proponent of just letting the downturn run its course, what he called liquidation. How did his perspective contrast with using low rates to fight the collapse?
Yeah, Hayek and the whole liquidationist school believed the Great Depression was a necessary, though obviously painful, correction after the unsustainable speculative boom of the 20s.
Which they blamed partly on easy money.
Precisely. They argued that trying to prop up failing businesses and prevent this necessary liquidation through interventions like artificially low rates and government spending would only prolong the downturn.
Making it worse in the long run.
That was their argument, yeah. Preventing the reallocation of resources to more productive uses would lead to a more severe, entrenched depression. However, well, as economic historian James Grant points out, the historical evidence isn't always so clear-cut. He cites the U.S. experience of a sharp deflationary recession in 1921, which was followed by a rapid recovery as a counterexample.
Okay.
And also, Japan's experience in more recent decades with mild deflation alongside continued productivity growth, that also challenges the simple story that deflation inevitably leads to prolonged economic stagnation.
So the aftermath of the Great Depression saw this big shift in economic thinking, right? A move away from Hayek's more hands-off approach towards more active government intervention and this focus on price stability by central banks. This brings us to the post-Bretton Woods era. How did this new focus on price stability influence how central banks used interest rates?
Well, the perceived failures of the more laissez-faire approach during the Depression led to this broad consensus among policymakers and economists. We need active management of the economy, and price stability became the primary goal, really, for central banks in many countries.
Right. Keep inflation low and stable.
Exactly. And this era also saw the rise of concepts like Goodhart's Law and Campbell's Law.
What are those about?
They basically warn about the unintended consequences of targeting specific economic measures. They highlight that if you try to control control the economy by focusing too narrowly on one metric, people will inevitably find ways to game that metric, making it less reliable as a true indicator. But the prevailing wisdom really became that stable prices were the crucial prerequisite for overall financial and economic stability.
However, Japan's experience in the 80s and 90s seems to complicate that neat picture, doesn't it? They had remarkable price stability, but still got this massive asset price bubble and then a long period of stagnation, even with low rates.
Yeah.
What can we learn from Japan?
Yeah, Japan's experience after the Louvre Accord in 1987 is a really potent cautionary tale. In an effort to stabilize the US dollar, the Bank of Japan significantly lowered its discount rate.
Okay.
These low rates stuck around for a long time and contributed to inflating this massive asset price bubble real estate stocks, even though traditional inflation measures stayed pretty tame.
Right, consumer prices weren't going crazy.
Exactly. But when that bubble eventually burst in the early 90s, Japan entered its lost decade, or decades really, of low growth, even deflation sometimes, despite the central bank keeping rates low.
So price stability wasn't enough.
It strongly suggested that, yeah, price stability alone doesn't guarantee financial stability. Low rates can have huge, potentially destabilizing effects on asset markets, even without traditional inflation. It raised big questions about whether central banks should also pay attention to asset bubbles, even if CPI is under control.
Which brings us neatly to the era of Alan Greenspan at the Fed, and this concept often called the Greenspan put. How did the Fed's approach to low inflation and its market interventions shape the landscape leading up to the 2008 crisis?
Well, Greenspan's Fed, operating in this environment of generally low inflation, developed a tendency to intervene quite actively to sort of cushion market downturns.
Right.
This led to the market perceiving this Greenspan put, basically, an implicit guarantee the Fed would step in to prevent big, sustained drops in asset prices.
So it encouraged risk-taking.
Many argue yes. That perception, combined with the relatively low rates kept in the early 2000s after the dot-com bust, is seen by many as having fueled the rapid growth of credit and the emergence of huge bubbles, especially in the housing market.
And the Fed didn't see it coming.
Even as these bubbles were inflating, the Fed focused primarily on traditional inflation measures, which looked okay, paid, frankly, scant attention to the rapid credit expansion and soaring real estate prices. They seemed to believe the consequences of a bursting housing bubble could be managed if and when it happened.
Greenspan himself questioned if they even could prick bubbles, right?
He did. And Ben Bernanke, then a Fed governor, argued shortly before the crisis that house price increases largely reflected strong underlying economic fundamentals. Hindsight is 20/20, of course.
Indeed. And Bernanke himself later put forward the global savings glut hypothesis as a key explanation for the persistently low long-term interest rates we saw leading up to the crisis. What was the essence of that argument?
Bernanke argued that a significant surplus of savings globally, particularly from emerging economies with high saving rates wanting to pile up dollar reserves, was pushing down long-term interest rates in the U.S. and other developed countries.
So it wasn't the Fed's fault, basically.
According to this hypothesis, this global savings glut, rather than the Fed's short-term rate policy, was the main driver of low long-term rates. Now, there are certainly alternative explanations, but the savings glut hypothesis, partly, helped deflect blame from monetary policymakers for the credit boom and the subprime mess, at least in their view. And the prevailing focus on inflation targeting also meant central bankers were often reluctant to raise short-term rates aggressively, even with burgeoning asset bubbles, as long as CPI stayed contained.
This period also saw the reemergence of the concept of secular stagnation. What exactly does that mean, and how does it relate to persistently low interest rates?
Secular stagnation basically refers to the idea of a prolonged, maybe even permanent period of very low economic growth and correspondingly low interest rates. It's seen as a more deep-seated, persistent condition than just a normal cyclical downturn.
Who revived this idea?
Larry Summers brought it back into discussion after the 2008 crisis. He argued that factors like slowing population growth, that high propensity to save globally, the savings glut again, and maybe a lack of sufficient investment demand were contributing to the state.
But wasn't this idea around before?
Oh, yeah. Economist George Terabor had critiqued similar stagnationist ideas way back after the Great Depression, pointing to the dynamism of the Roaring '20s as evidence against that kind of long-term pessimism.
Right.
Interestingly, Summers himself later started to question whether the very policy of keeping rates ultra low for so long might actually cause secular stagnation.
Ah, the cure becoming the disease.
Potentially, yes.
Yeah.
By fostering financial instability, misallocating capital, reducing overall economic dynamism, and research by Claudio Borio at the Bank for International Settlements also supports this idea that low rates can contribute to the buildup of financial imbalances that ultimately hinder sustainable growth.
So the narrative has shifted a bit, from low rates being just a symptom of stagnation to maybe being a contributing factor. This leads us right into examining some of the key unintended consequences observed in this era of ultra-low rates after 2008. What have been some of the most significant negative effects?
Well, one particularly significant one seems to be the hindering of what Joseph Schumpeter called creative destruction.
Right, the process of new industries replacing old ones.
Exactly. Ultra low rates have made it cheaper for less productive zombie companies to just keep servicing their debts and stay afloat. This prevents the natural reallocation of capital and labor towards more efficient, more innovative businesses.
Is there evidence for that?
Yes, research by the Bank for International Settlements found a direct statistical link between periods of low policy rates and the prevalence of these zombie firms in advanced economies. Furthermore, persistently low rates have lowered the required rate of return, the hurdle rate for investments. This potentially traps capital in low-return ventures that just wouldn't have been viable in a higher-rate world. There's that analogy often used about forest fire suppression.
Oh, right.
Explain that.
The idea is that by constantly putting out small financial brush fires with low rates, central banks might have inadvertently allowed the buildup of more significant imbalances like deadwood in a forest, setting the stage for potentially larger, more damaging crises later on. Bernanke dismissed this, saying firefighters don't cause fires, but the analogy persists.
That's a powerful analogy. And we've seen this manifest in various ways, haven't we? Like the huge increase in mergers and acquisitions, private equity activity, and all the share buybacks by public companies.
Yeah.
How have low rates fueled those trends?
Exactly. Cheap borrowing has fueled a massive boom in M&A. Many deals seem driven more by financial engineering to, take on debt, buy the company, slash costs rather than genuine strategic logic. The Kraft-Heinz merger is often cited as an example.
Right.
Private equity firms have absolutely thrived in this low-rate environment, using leveraged buyouts, financing deals with tons of debt to boost their returns.
And the buybacks.
Large public companies, often with exec compensation tied to stock prices, have increasingly prioritized share buybacks over investing in future growth. In the U.S., the total amount spent on buybacks actually exceeded total capital expenditure in the post-crisis period for a while.
Wow. More on buybacks and investment.
Yeah. The U.S. Office of Financial Research has warned the focus on financial engineering can detract from investment in innovation and long-term productivity. The decline of a company like General Electric, once an icon, is partly attributed by some to excessive financial engineering and buybacks, prioritizing short-term maneuvers over long-term business health.
It's a cautionary tale. We've also seen the rise of numerous loss-making companies going public, haven't we? And this surge in speculative investment in assets like Bitcoin or high-end contemporary art, how do ultra-low rates contribute there?
Well, in an environment where traditional, safer investments offer historically low returns, investors just become more willing to take on bigger risks, hunting for higher yields.
The search for yield again.
Always. This has led to situations where companies with no clear path to ever making a profit have been able to go public, with investors focusing on growth narratives rather than actual earnings.
Like the dot-com era again almost.
Yes, there are definite echoes. Similarly, the search for alternative assets promising potentially higher returns has fueled speculative booms in things like cryptocurrencies, Bitcoin being the obvious example, and the high-end art market, where prices for certain works have hit astronomical levels, often seeming completely disconnected from any fundamental economic value. This trend kind of echoes historical concerns, like those from Frederick Soddy or even Adam Smith, about the potential divergence between creating real wealth through productive activity versus just proliferating complex financial claims on that wealth.
And all these trends seem to have contributed to what's often called the increasing financialization of the economy. What does that term really encompass?
Financialization basically refers to the growing dominance of financial markets, financial institutions, and crucially, financial motives in the overall economy. Instead of seeing finance shrink back after the 2008 crisis.
Which you might have expected.
Right. We've actually seen finance contribute an even larger share of overall U.S. economic growth in the period since then.
How did low rates facilitate that?
Well, they facilitated increased borrowing, fueled all that M&A activity, boosted activity on Wall Street generally, inflated asset prices, increased the earnings of hedge fund managers, other asset managers. The finance sector's slice of the economic pie just grew significantly.
To finance sort of replaced industry as the main driver.
Some argue that, yeah, finance has in many ways supplanted traditional industry as the primary driver of economic activity, a situation many economists believe is neither sustainable nor necessarily good for long-term wealth creation for the broader economy.
Okay, now let's shift focus a bit to the impact of these ultra-low rates on ordinary individuals, savers,
Yeah.
people worried about rising inequality, and just the overall levels of debt.
Yeah, the impact on savers has been particularly stark, hasn't it? Low rates have really penalized anyone relying on savings income. Returns on bank deposits, fixed income investments have been just historically meager.
Creates a wealth illusion.
Arguably, yes. Rising asset prices might make some feel wealthier, but people without significant assets see little benefit, while their savings generate basically nothing. And declining rates have also dramatically increased the present value of long-term liabilities.
Like pensions.
Exactly. Especially for pension funds. It created what's been called a bull market in liabilities, making it much harder for them to meet future obligations.
And the link to inequality.
Well, there's a growing body of evidence suggesting low rates have exacerbated wealth inequality. Those who already own significant assets benefit most from asset price inflation and cheap leverage to buy even more assets.
While others.
While lower-income households, often facing stagnant real wage growth, have faced pressure to borrow more just to maintain their living standards. In a way, Bastiat's old warning about potential negative consequences for the poor from messing with the natural rate seems to have a modern echo here.
We even saw some central banks in Europe and Japan implement negative interest rates.
Yeah.
I mean, that just seems to fly in the face of the fundamental concept of lending. What were they trying to achieve and what actually happened?
Yeah, adopting negative interest rates, Switzerland, Denmark, Japan did it, was indeed radical and kind of counterintuitive.
Really bizarre, right?
As Bohm-Bawerk's idea of time preference suggests, it really goes against that basic human inclination to prefer stuff now over later. The intended goals were usually to stimulate bank lending and encourage investment by making it costly for banks just to sit on reserves at the central bank.
Did it work?
The actual implications are still debated. Denmark's experience, for example, suggests negative rates might have actually led to an increase in private savings.
Oh, the opposite effect.
Possibly, yeah, as people tried to compensate for lower returns. And maybe even a reduction in private investment in some areas. The theoretical strangeness of negative rates just underscores how unusual and potentially distortionary the economic environment created by these prolonged ultra-low rates has become.
And these historically low global interest rates, they've also had significant ripple effects on emerging market economies too, haven't they?
Oh, absolutely. The period of low U.S. rates especially triggered huge capital flows into emerging markets as investors chased higher yields. This often boosted local asset prices, commodity prices.
Didn't some people link it to the Arab Spring?
Some analysts did argue that these flows contributed to social and political unrest in some regions, like the Arab Spring, partly by inflating food prices. Whether that's the primary cause is debatable, but it's a connection that was made.
And then when the Fed started tightening.
Exactly. When the Fed began signaling tighter policy and eventually started raising rates, many emerging markets, big ones like Brazil, Turkey, experienced significant capital outflows, currency depreciations, and economic downturns. The tide went out.
And China. They had a huge boom.
China particularly experienced this extraordinary surge in credit growth and a massive real estate bubble, fueled partly by these low global rates and its own policy of keeping its exchange rate relatively stable against the dollar.
Which brings us to the concept of financial repression in China. Could you explain what that means and how it relates to their interest rate policies?
Sure. Financial repression, a term defined by economist Ronald McKinnon, refers to a set of government policies that deliberately keep interest rates below the rate of inflation.
Why would they do that?
It effectively transfers wealth from savers to borrowers, and the borrowers often include the government itself and state-owned enterprises. China's policy of pegging its currency to the dollar and keeping rates relatively low, especially after joining the WTO, led to a significant period of financial repression.
And this fueled their growth.
It certainly helped. The undervalued exchange rate and low cost of capital fueled its amazing export-driven growth and the massive credit boom that went with it. But
Right.
the downside was this rapid accumulation of household and corporate debt, a huge real estate bubble, and significant risks building up in the financial system, including the growth of a large, opaque shadow banking sector.
Now, Edward Chancellor concludes this part of The Price of Time with a section titled The New Road to Serfdom, which is a direct reference to Friedrich Hayek's famous work.
Yeah.
What are the concerns being raised here in the context of prolonged low rates and increasing state intervention?
Well, Hayek, in The Road to Serfdom, famously warned about the dangers of excessive state control over the economy and the potential erosion of individual liberties that can come with it. So, in the context of persistently low rates and central banks relying more and more on unconventional monetary policies, concerns arise about the growing influence of state-backed institutions in financial markets and the potential for unintended consequences for individual economic freedom.
Like what specifically?
Well, there are discussions around the implications of moving towards a cashless society, the potential for central bank digital currencies to give the state much greater oversight and control over financial transactions, raising
Yeah.
concerns about privacy, government surveillance.
Right.
Now, it's worth noting that the period after World War II saw surprising economic growth in many countries, despite significant financial repression and high taxes. Keynes had that famous quip about the euthanasia of the rentier.
But things are different now.
The underlying economic and geopolitical conditions today are arguably quite different, yes.
Finally, the book concludes with a postscript titled The World Turned Upside Down, describing the truly extraordinary market conditions after the COVID-19 pandemic hit. What was so remarkable about that period regarding rates and valuations?
That period immediately after the pandemic hit was, well, truly unprecedented market conditions. Interest rates in many developed economies were slashed to near zero, sometimes even turned negative for government bonds.
Negative yields again.
Yeah, and asset valuations across various classes just reached historic highs. An astonishing amount of global debt was trading at negative yields. Investors were literally paying borrowers to hold their money.
Just wild.
Charlie Munger, Warren Buffett's partner, described the market frenzy as the most dramatic thing that almost ever happened in the entire world history of finance.
High praise or maybe high concern.
Right. There was this widespread sense, popularized by figures like Dave Portnoy, that the traditional link between economic fundamentals and asset prices had become completely distorted. Some even suggested the market was somehow rigged.
Like a casino.
Chancellor concludes by invoking Lewis Carroll's financial wonderland, where established economic logic seemed totally inverted. It just
Mhm.
highlights the truly exceptional financial environment created by the pandemic, combined with those extraordinary monetary policy responses.
So, after this incredible deep dive through the history and the multifaceted impact of interest rates guided by Chancellor's The Price of Time, what would you say is the most crucial takeaway for our listeners?
I think the most crucial takeaway is that interest rates are just far more than a simple technical tool for managing the economy. They have this incredibly long, complex history. They profoundly shape economic activity, influence social structures, even spark moral and political debates across centuries.
Right.
And the prolonged period of ultra-low rates we've lived through recently has created this really unique set of economic conditions with potentially significant, often unintended consequences that, frankly, we are still grappling with today. It's a reminder that the seemingly mundane price of money has a surprisingly powerful and often unpredictable influence on our world.
And what's the final thought you'd like to leave our listeners to perhaps ponder on their own?
Given this intricate history and all the potential downsides we've explored regarding manipulating interest rates, perhaps the most important question for you, the listener, to consider is this. What is the true price of time in our modern economy? It's worth reflecting on the long-term implications of these policies and that delicate, maybe impossible, balance between managing the immediate economic situation and safeguarding the prosperity and stability of the future.